I get to talk to Ben a lot, and not because I'm special, is because he actually is very generous with his time, whether it's on the forums or on Twitter. It's not that I think XEQT is the perfect product. It's just close enough to what probably is decent. It's just the current vehicle that matches my philosophy the closest. It could easily be VGRO-T, ZEQT, or even FEQT at some point. Even if the market goes down, it doesn't mean you made a bad decision.
Hello everyone and welcome to Momentum Finance channel. My name is Mo and today I'm super honored to bring a favorite of our Blossom, KYT. Welcome to the show, Car.
I am excited to be back. I re-listened to our first interview. It was fun, and I'm happy to talk with you again in sort of person mode.
You know what, these days, Car, I feel like time is a hot commodity. Given that you are now having your second child, wow, I mean, your hands are probably full. Thank you so much for making some time for us. How's that coming along?
I mean, I thought for sure that the second child would be easier at first, or the same, because you gain that experience, that confidence from the first one, where the wife and I, especially the wife, was going through some depression, because postpartum depression, as you must have heard, where the baby's crying, she doesn't know what to do, and it's really easy to get depressed. What I underestimated was the time. It's exponential time, because now you can't tag team one baby. Each of them needs attention at all times, so neither of us really gets to rest. So that's the key issue. So if you ever think of getting a second one, I'm telling you, it's just another level. It really is.
Yeah. Think again, probably for sure for that one. Yeah, I think we are good with the one that we have, and yeah, I can totally attest to even though that's first child's experience going through that first year. Until you get to a certain point, Corey, you probably have already seen it. At a certain point, you're like, oh, we figured this out. Like, it's starting to get a little bit back to normal. I'm sure you're going to get there. You've seen that first time experience. Now, let's get into the world of investing in topic of finances. That's a hot topic. I know even despite the fact that you're quite busy with your second child, still, most recently, you've started to become much more active on Blossom. Thank you so much for all your fantastic posts. And you do post regularly these days on Blossom. And not only that, you do interact within other posts, respond to the comments, try to help and support particularly our new blossomers. In preparation for this interview, I know you did make a post on Blossom and asking the community, are there some questions that they like us to discuss? Like, what are some of the questions that would be of interest? And I'm going to go through some of those questions. But one thing stood out for me. In one of your posts, you did bring up somewhat of a product that I had not heard about myself, admittedly, especially the versions with some sort of distributions on a monthly basis. You know what I'm talking about? I'm talking about the VGRO-T.
I think eventually BMO will release the entire suite, basically the .T dash or .T series of the entire all-in-one line. So right now they have, I think, 2 or 3 of them, which is more like either the Grow version and the BAL version, where they target a 6% distribution monthly. So it's really the exact same product, but they're going to essentially sell for you. So taking away that psychological hurdle that some investors have with again, I've tried to specify, like, everyone thinks that anything that's non-income, non-dividend is growth, but the more nuanced take is like these all-in-ones are generally a blend of many different companies, like value stocks even, and everything like that. So it's more of a blend strategy. So this index strategy, a common thing that people will say is like, I don't want to physically have to sell, which is, a fine opinion to have, just like how I think in my first interview, I actually said like mutual funds might be good for some people. It's got higher fees, but some people aren't necessarily tech savvy. They don't want to deal with anything. So mutual funds or a robo-advisor is perfect for them. And this is sort of marketed as a retirement fund. And again, it's for people who want that consistent distribution without having to go in to a brokerage account and actually have to sell shares.
That seems these days to be appealing to many, particularly I would say a lot of folks that are at retirement even, and you coined it well, Car. You're still talking about that psychological aspect. I mean, when I think about it myself, I was having a kind of a challenging time as well, like reflecting back. I've done a lot of interviews with folks that are into income camp, passive income, like distributions through covered call and whatnot, and also others that are ETFs and a mixture of all. I'm not gonna lie, when you talk to folks, sometimes you feel like, oh, it's actually kind of cool and neat that imagine you are at retirement or at a stage whereby like cash flow matters to you. You don't have to do anything. Essentially, like all you do, you expect that a certain day I can expect this to come. Now, we are not looking under the hood to kind of uncover exactly specifically where that income is coming from. And I know there have been a lot of great posts on Blossom around that. Mr. Financial has posted some really fascinating posts around that as well, and others. So I think that psychological aspect is still there. And sometimes for those folks, they also bring up the fact that, well, they don't care about underperformance. They don't care about like necessarily where is it coming from. As long as I get that, that's what I care about. I need the cash flow. And your thought process here, your counter argument to that is that, even if the fund does not pay you a regular monthly or whatnot distribution, you can still access that to selling some shares. Touch on that. Elaborate on that more, Kar. How do you envision that to happen?
So first thing I want to address is like when it comes to, there's a lot of things that me and you and a lot of people say, but me and you and let's say specifically, I will call it, I was thinking of what to call it. I'll call it level zero knowledge, where we say certain things that are shortcuts to, not to mislead, but like a shortcut for beginners to really grasp a concept quickly when there is a lot more nuance. So to sort of pump our strategy a little here, for an example, is like we might say to a beginner, if you don't have time to invest, indexing is great. Level zero, easy to understand. You don't have time, you don't want to do all these things. But then the higher level understanding is like what I say, it's actually you want to index regardless of how much time you have because of market efficiency. Though some active investors might have an edge here and there, but the general concept is even with a lot of time, it makes sense to index. So that might, not people might not be able to gravitate towards that right away until they gain more knowledge. And talking back to income, what I'm trying to say is a lot of people have this level zero concept that they've heard about is that you have to be growth early and dividend later. Or because I have to retire, I have to gravitate towards income products. And I think it's just a marketing thing, really. You need income, but that income can come from any number of sources, including selling shares. And what I wrote about my piece is that mathematically, what happens, and people know this about, they say this about companies, is that they're reinvesting in themselves. And as long as the non-dividend, the index strategy, has similar total return as whatever income strategy that you're comparing to, what's going to happen is you're going to have less shares in the index strategy, but every share is going to be worth a lot more. To the point where at some point, like the word Perry mentioned, he's worried about the meltdown, or eventually I talked to Riggs as well, like you might sell until you have nothing. That's not actually true. If you map it out, if you have positive expected return, or even, it doesn't have to be huge, as long as you're not withdrawing more than the return, all that's happening is eventually you're going to sell like fractions of a share or something. It's going to approach zero as the years go to infinity. And I think people are missing that relationship, this mathematical curve that's going to happen. And so for people who are worried, I just encourage, like, do the math, show me how it's melting down, and I challenge anyone to show me how it melts down.
And you did do a kind of side-by-side comparison of VGRO-T and VGRO, if I recall correctly, right? And one is focused on the distributions regularly every month, and the other one just total return. And very, very, very similar, wasn't it? Almost
very similar, and you can even see the share price difference between the two times. And you can see one's growing faster in share price and one's growing faster in share count. And again, you can't look at, basically, that's why we preach total returns. You can't look at one of them and say one is faster, slower than the other one. You need the whole formula. And once you know the whole formula, you're like, this is exactly the same thing.
The stock market, the US stock market has had a wonderful decade, as we know it very well. Brings me to a question that was brought up by one fund fire on Blossom. So we had three questions, but one of them was, what made you choose an all-in-one ETF over holding a portfolio of individual ETFs or stocks?
I think it's really, I refer to the first interview where I said I listened to certain financial advisors, like 3 of them, even though they're like all loosely or were connected to PWL Capital at one point. So kind of a biased trio of sources between Canadian Couch Potato, Justin Bender, and Ben Felix. But beyond that, there were other podcasts that were just recommending the same set of products. So that's where I gravitated towards first, trying to understand why people were recommending these. Ultimately, like I get to talk to Ben a lot, and not because I'm special, is because he actually is very generous with his time, whether it's on the forums or on Twitter. He'll talk to me privately. No, I could easily have daily chats with him until he becomes like ultra famous. But he just said like all in one, like is just if he was didn't have access to dimensional funds, he would just invest in all one because it's basically good enough. And anything little extra thing that you mod, it's just not clearly better. So if you're comfortable with just set or forget one ETF, you should do that. And we both hold Ben in the highest regard. And I'm like, if that's good enough for him, if he were to be a retail investor with no access to special funds, it's good enough for me.
Is that why you have not kind of been swayed or tempted to necessarily look into factor tilted ETFs, which FEQT seems to be a popular one these days too?
Right. So I'm with Ben on crypto. It really depends on your opinion on it. I think no, you can't be right or wrong on it because it's a speculative asset. If you want to have it for diversity, you can. If you don't want to have it because you're unsure if it has positive expected return, then that's a reason to not hold it as well. So I think whether you're on or off that side, that's fine. And I think here people are too swayed by the factor naming of these funds. Or Ben on his show and talking to him, it's all about the methodology of these funds. Like, how are they targeting these factors? And people don't talk about that. They just say, oh, they target these factors, so it's good. But it's like how they target those factors. Does it have high turnover? Does it have high fees? And the conclusion from the Rational Reminder crowd is like, it's not clear that it's worth the cost just because they name their funds that way to appeal to the factor crowd. It really doesn't mean they're doing it the best way, but it's not clear that they're doing it in a bad way either. So you're in a situation where, XEQT and FEQT, I'm just like, whatever, right? At this point, it's like, if you want to be like Regis is really hardcore switching back and forth because of, I guess, recent results. But like, to me, it's like, it doesn't matter. That's why he's worried that the XEQT crowd will go after him. But I'm like, it probably doesn't matter all that much. But looking at FEQT, it holds a lot less holdings than XEQT. So they're just like slight reasons. But I never go out of my way, like some of these other Blossom posters, to crap on FEQT. I just say why I don't hold it, while other people are going to be like, oh man, it's done so well. XEQT sucks. You've seen those posts. So, I mean, yeah, I'm a lot more respectful in the when looking at all these all-in-ones.
I mean, and to me, Kar, thanks for bringing that perspective. To me, the success of folks investing in FEQT, success of folks investing in VEQT, success of folks investing in all these type of similar, I would call it quote unquote similar products, is a positive. Because at the end of the day, if folks are investing in diversified products that gives them distribution of risk, not only like only focus on, let's say, one specific stock, or only focus on one specific sector, or like, I think that's a positive thing to see and hear. At the end of the day, the differences might be there, and I mean, who knows? Like, there might be years that maybe XEQT does perform better than FEQT, or vice versa. But to your point, I guess hopefully I'm not putting words in your mouth, but I feel like when we are investing in these type of approaches, we are not trying actually to beat the market. That's not our intention. Is that from you?
Yeah. It's not like I think. I make sure I write this in almost all of my posts, where it's not that I think XEQT is the perfect product. It's just close enough to what probably is decent, so let's roll with it. And I think people who are actually trumpeting what they hold or identify with certain stocks, like they try to project that onto me, and it's like, no, I'm not that tied to XEQT. It's just the current vehicle that matches my philosophy the closest. It could easily be VEQT, ZEQT, or even FEQT at some point, maybe. Like, I don't really care as much.
Yeah. If you had to make XEQT or a product like that better, if you were the fund manager, what would you tweak about the product right now? You don't know? Would you change anything right now at this moment, or no? Is there anything that maybe you don't love as much about it, based on your research and what you've come across?
I'd have to research more on home bias, but otherwise, like, there are reasons to be home bias. So again, it's really hard to say. I think at the end of the day, something that's close to market cap with a little bit of home bias, you can't really say it's bad. Like, that's That's I really can't see. Maybe I don't know. I have to research more on, I guess, like how it decides to diversify internationally and go really deep in the weeds about like why it selects certain things. But otherwise, I think I don't have that knowledge to tweak it at this
Yeah.
point.
And you've been investing in XEQT for a long while, right, Car?
Since 2020.
Wow, yeah. And then that's the fund as well that allowed, I mean, your diligent investing and saving on the side, I can imagine, also led you to be able to at one point sell some of your shares and use it for down payment for your home. I know that you did share that as well on Blossom. Do you mind touching on that? Because Nick had a question, in fact, on Blossom asking, hey, you sold a part of your long-term portfolio to buy your home. And I believe that they were interested from a similar type of thought process. Like, do you regret doing this? Do you recommend to do so for someone if they were also trying to buy their primary residence? Basically, they wanted to know your experience with selling XEQT to have some money for your down payment.
Yeah, of course, I wanted to keep my portfolio as long as possible because I was more confident in the positive expected return of a portfolio than the house I was buying. Rather, thankfully, I'm not in Toronto, where real estate values has dropped quite significantly from the peak. So there is risk, like real estate, like I guess eventually recovers, but there is risk in that. And here it's like it's tough to give a general perspective because my reasons for buying a house is very specific to my wife, to my first daughter, well, my only daughter. I have a good combo, but my daughter outgrowing the space that we had where it was like I didn't think she would do it so fast, but she was growing up where we really felt like she needed more room to run and play. And my wife wanted the comfort of being able to alter the house as she wanted without having to ask the landlord if they could do this or that. So for that reason, like I just had to do it.
You know what? Actually, I remember the first time that we were doing the interview. Your daughter came in behind the door and knocking on the door. I was so cute. She was way smaller back then, but yeah, it's amazing how kids grow so fast.
Yeah, I just feel really good. I guess saving for RESP and just thinking about like how, I had the luxury. I think what was it? Regis's son just posted about who
Anthony,
pays
right?
for his studies, right? And I had the luxury of my dad just like deciding, well, he just paid for everything, but now that I think back, I wish I could have contributed, but we had a family where my parents or grandparents just thought like have us focus on studies and not work early, which has its pros and cons. And like the con was for me that I didn't have early work experience, which I would have liked instead of being like much older and being at my first job. That was kind of, it felt, I guess I was a little shy about the whole thing because, I'm just new, but I'm like, I get my first job. I don't think I was exactly like 20 years old or something, but like, let's just say I was. Whereas we're saving for our kids so that they have like this smooth ride in post-secondary education. So that's very very different than well, it's not different. What am I talking about? Like my dad paid for everything, and I am investing for my kids. But I guess it's very different from like what Anthony's talking about and what my wife lived through, where she worked different jobs. She worked at a fast food restaurant. She worked at her first job was like an ice cream shop when she was
Wow.
16 or younger.
Yeah.
And so different paths to pay for what our kids might need in the future. But it's just when you look at how good the RESP is with the grant money and how it can grow tax free, it's just, I just think about how awesome it is. And every now and then when I log in to check the RESP of the two kids, I just brag to my wife, like, imagine if we had this at like she's 3 and she has 5 figures
Yeah.
that we have devoted to her, right?
Yeah.
Like that's kind of nuts.
That's incredible. And Team XEQT all the way,
Yeah,
even in RESP? Yeah.
yeah,
Nice. That's awesome. What is the one financial lesson that you would like to pass on to your child when they grow further?
yeah. It's tough. I mean, we see a lot. I'm curious. I don't know if you've publicly talked about this yourself, but we definitely see a trend of parents saying they want to because they realize how important it is as an adult, right? And then they're like, they should have taught us this at school. I'm just going to hammer these concepts to them when they're young. I'm undecided on that. I'm not really sure when I want to do that exactly. I don't want them necessarily, like some people that have them investing really young, they might also get the wrong lessons if they spike really big on a stock play, right? And so it's really unclear to me if they really need, like for me, all I need, watch your dad's videos. No, I mean, all they need to do
That's a good idea.
is understand market efficiency above all. I think that for me is the most important lesson than any vehicle or savings, because that is the foundation by which both of us invest the way that we do. Once you know the market is efficient and you know that you can find edges possibly, but they're not necessarily sustainable or necessarily always there for you, then you're going to approach it in a very responsible way, sustained, responsible way. For people who are still sort of confused about market efficiency, I talked about sports betting, which is very niche in the first episode, but now there's Polymarket, there's a US site called Kalshi. It's where people can bet on certain specific outcomes. They're more specific than, like, stocks has so many variables, right? So it's unclear. Like, people on Blossom ask all the time, why did this stock go up or down? It could be the most obvious news, but it could be something that is like sort of related. Like maybe an industry partner went down. Like there could be many reasons why a company's stock price go up or down. But here we're talking about like these prediction markets is where people can buy and sell. A notable one is who would win the US presidency, who would win the Canadian election. And you can see how recent news people are pricing in.
How is it different from gambling, though? So there are two aspects to it that stood out for me. One is the wisdom and the knowledge of the crowd. So essentially, like it's amazing how many times they get it essentially for the most part right. Correct me if I'm wrong, but it seems like there are a lot of times because there's like it's unbiased, right? Like different perspectives participating in. But the part that kind of doesn't sit well with me is the fact that it is in a way kind of gambling, right? It's like, okay, well, 50% chance almost, and you're kind of gambling on one outcome.
Like if you're a regular guy with that's what like stock picking. If you're a regular person with no inside information or edge, you are
Right.
gambling.
Yes, yeah.
And the people who have that information is what is controlling the price of the, or making these markets efficient. So, for example, we if we it's not available anymore. We saw people like betting on whether Mark Carney would be the prime minister or not, and so you would see the price. But what allows you to see how efficient certain markets are, as more polls came out that Carney was going to win, the price would go up. So you couldn't bet on him at a good price anymore because of how the information reacts. Now, there's obviously caveats to that because these markets are relatively new. It requires basically a market requires a lot of rich, informed users with
Participants, yeah.
active to make sure the prices are efficient. Like you need them to bet like all the good prices so that when Mo and KYT log in or whatever and want to bet, the good prices are no longer there. That's the point of market efficiency, which is what it is gambling, which is why stock picking is gambling. So that is the key lesson
Interesting, yeah.
that you should take away. You look at these just to see where the market is predicting. It could be something silly like, I don't know, we say like, is Trump going to say this tomorrow or whatever? There's a bet on everything, but only the bets where a lot of action is happening can you really trust the price. It can't be something like, Nish, where me and you are betting on something. That won't make the price efficient. But if it's something that people are very interested in and heavily bet on, then you know that the market generally has a good idea. And that's where I want, because like my kids to understand, because you'll hear this a lot, that people think the market represents the average investor, right? The average prediction. That's not true. It's really controlled by the most active investors with the most money that are predicting with their money. Some people think of companies as if you're just investing in the company itself, but you're really competing against, like, you're bidding against, like, the company's over there and you're bidding against its price with other buyers and sellers, right? That's what's actually happening. If you were like a rich fund and you had early access to poll results that were reliable, you can make a lot of money because then you'd be the first one to bet on all these cheap prices. You're the one that's going to move the market up because all the sellers, because like it's like asking price, right, for XEQT or any or any, there's like different levels of asking price, and all those people are just actual people that have contracts that they're willing to sell. And at some point, those people are like, oh, holy crap, the price is wrong. They're just gonna pull the price. That's what causes like this huge price spike, because all of them realize they're either gonna get their contracts bought, or they're just gonna like cancel. Like they're gonna take back the contracts because they don't want to sell at that price anymore. And then that's where you have this like information surge that causes this price rise.
There was one question on Blossom. What's your personal reason for not tilting towards factors? I think you touched on that.
Yeah. I think
he was asking about, is it simplicity, lack of a fund that fits your criteria, or just the juice is not worth the squeeze? Any final thoughts on that? We did touch on that earlier.
I think it's where it's like simplicity is king. And if it's not obviously better, then answer is like, just do what you like, right? Like, but
pick one and go with it.
if you need a heuristic to choose, then pick the simplest option, right? If all things being equal, pick the simplest. That's it.
Yeah, that's fair. That's fair. Jamie, who was actually interviewed recently on another podcast, he had a question. If you were to take $50,000 and build a rock solid passive income portfolio, wait for it, which positions would you pick and buy? And I know we're not here, A, I know you're not a passive income investor necessarily, and B, we are not providing any financial advice. But any thoughts on that question?
Like we talked about the retirement ETFs that BMO has, that's what I would gravitate towards. I would also look at Vanguard has a retirement specific one. But if people were thinking about how we construct it with all these popular covered call ETFs, it would just be the most diversified option possible. So if I were to have HHIS, the really popular one that Joe wants both of us to get into, then it would have to be countered with things that are outside of those 15 stocks based on our philosophy that we wouldn't want to concentrate our fortunes on the outcome of these 15 stocks. Because
have you looked into some of the options that Adriano looks into? Like, Adriano, I don't know if you're familiar with him, but he's more so the thought was that he doesn't want to have concentrated covered call ETFs. So what he's doing, he's essentially buying the covered call versions with some leverage of the NASDAQ, the S&P 500, the things of that nature.
I've actually watched a lot of the videos you've done recently, and I think even Paul and Perry both have like their own philosophy of being diversified. So I would think of something like that, but it's, again, to Jamie's like question, it's just like, it's really hard for me to, because it's just counter to just hold the underlying, the bad argument is when people compare the underlying to the covered call ETF of a single stock, because like you're talking about a single stock so volatile that you can't draw a real conclusion about it. So what? Like it went up in a year or two, like doesn't mean anything. But our philosophy is the broad market will go up over time. And so it makes no sense to hold the broad market in a covered call form, right? That's why it's like, it's hard to ever go to the other side because of this one belief. Broad market goes over, you want to, underlying diversified is good enough, and then be comfortable with selling shares. I did want to touch upon one quick thing that I didn't before about one of the key cons, because I like on Blossom now, the better approach is to talk about why certain people are wrong about your approach rather than attacking theirs. I think it's a lot more productive.
Yeah.
So one of the things that people get wrong, and I think Harry mentioned it, and it's a valid concern when you think about it intuitively, which is if you hold the S&P 500 or XEQT, like they're scared that you've heard market timing, that you might have to sell on a down market. My counter to that is like everyone at some level is doing some sort of market timing through their buys or sells, even the passive income investor. When even Paul in his recent video talked about how he's actually an active passive investor, because you have all these metrics that you have to monitor. You might sell certain, like even in retirement, right? These guys might have to, and they are doing it, which is sell a product for a new yield product that has
swap and change, yeah.
Right, that has kept their distribution more consistent according to them. So I think it's unfair to then look at someone who holds an index and say that you have to market time. Like you're both in both styles, you have to make a number of decisions, and they might be different, but you still have to make a lot of market timing type decisions. Like you get let's say 20% yield, and you say that's more than you need, how much are you going to redeploy in the market? And you might change your mind based on the market conditions, right? You might think you're buying a dip, not buying a dip. So you're making a lot of timing decisions anyway. But to that's why you don't obviously need to go to passive income route when you're retiring. You can just have one ETF, sell the number of shares that you strategize, and that's it. I think the example Perry used was which is good, for, the typical growth investor that might have Google, Microsoft, Nvidia, right? All these concentrated holdings. Which one do I sell? That's a fair point. But again, that's another typical active decision that someone has to make, and maybe people are able to do that. But for the S&P guy, for the XEQT guy that only has one fund to sell, you can't convince me that's harder than the other styles.
And you're not technically you're not timing, especially if you have some sort of rules in place. For example, you might say, well, for me to sustain my retirement costs, I need X amount of $1,000 every month, and I'm gonna sell how many shares that I need to get that amount on this date. Now, it doesn't mean that, what if you had a little savings on the side and market suddenly tanked, you might be able to just be fine not selling because maybe you don't want to, sell at a really low cost. On that note, Car, do you see, and right now, based on what you know at this point in time, do you see yourself building those bucket strategies? Some people talk about okay, have maybe a cash bucket. You have also another bucket for maybe more reliable, like maybe GICs and then only like a all equity bucket. Or right now you would see yourself necessarily holding on to all equity at this point.
So I think, thankfully for both me and you, it's still a number of years away. But I do think there is a good argument for at some point our portfolio size gets so high that future expected returns aren't that important to us because of the diminishing returns. We're already we've hit our goal, and anything extra is just butter on top. And we'd rather, to the logic of the income crowd, we would really be willing to accept lower expected returns in return for just safety, right? I could see a world let's say both of us have more, 1 or even 2 million or even more, not wanting to lose 30% at any random year. So I think at some point it becomes let's not try to be as rich as possible. Let's make sure we have enough to sell for multiple vacations when we're both pretty old, or give back to whatever we want to do. But we have a great amount to either make meaningful memories with or to give to our future generations, whatever you prefer.
Lump sum investing versus DCA as well. Building on that question, waiting until the markets are hot these days, they're pretty much at all-time high. Should they wait? Should they actually invest? What's your take on it?
I think some people are definitely, they don't have portfolios like us, so they might be misapplying quotes that were based on studies on diversified strategies. Nvidia, keep putting it in because time in the market is better than timing the market. I mean, that doesn't apply here. It just applies to the market as a whole. So, and most people don't really have a huge windfall or a lump sum like I did. I randomly won a lot of money, was able to lump sum into XEQT. But a lot of the questions we see don't really matter when it's weekly or daily. To be so granular at that scale, it's okay, just do whatever feels best to you. But the logic is still the same, where if you're in a diversified strategy, then the earlier the better for the highest return. But I wouldn't say the same thing just to our my $2 million example. If you're late in the retirement game, then you have to think about it a lot more. But if you're young, the answer is just really easy. Just put it in. Then it becomes more and more complex based on your life situation. It can there's no right or wrong answer. If someone's they're 55 or whatever, right? You don't want to tell someone to lump sum an inheritance or whatever they got, right? This huge amount that they might need to save a certain floor, right? And all that to say, it can be more nuanced than just pure lump sum,
Simple.
which is our default answer, obviously.
Part of it, to your point, I think that you're getting to as well is like also that psychological aspect of it. While there's data that suggests, particularly if you're investing in a like diversified portfolio, having it as a lump sum, there has its benefits compared to like let's say trying to like, oh, gradually put it in and maybe trying to find that dip. The truth of the matter is actually the markets never come and announce that, oh, I'm gonna have a dip next week. I mean these days, I mean with current presidency in the US, it seems like the markets, I mean, probably markets always has ups and downs, but these days it seems like it's a lot more chaotic, and the directions that it can take can really sway quite a bit. But nonetheless, I feel like there is that psychological aspect to it too. So when folks ask me, take to them, the comment to them is that typically investing in lump sum may have longer term kind of better benefits. But that said, if psychologically you feel a lot more confident to gradually put in your money because it allows you to sleep better at night, and you feel like, oh, you know what, shoot, I just bought it and now suddenly markets went down, then you're gonna kind of be mad at yourself for that. Then don't do that. Then maybe gradually buy. Like whatever. At the end of the day, there's no, and we are not saying there's a perfect answer here. It's at the end of, there's so many factors involved.
I think actually when I think about it, it's like DCA is the safest advice now that I think about it. Instead of like lump sum is what I'll say is the more nuanced, correct answer. But the reason why DCA is better is because it's harder for beginners to know that even if the market goes down, I came up with examples and analogies before. I don't know if you've read them, where even if the market goes down, it doesn't mean you made a bad decision. And that part is hard because people feel like, oh, I made a mistake. Right? We read these posts a lot when it's went down. Like I put it all in January, but I made a mistake. But it's no, like if you invest it in a diversified market, it's hard. It's basically almost never a mistake. And as a beginner, it's hard to do that. It's hard to, that concept is hard to get around, I think, for a lot of people where like even you might have doubted yourself, and it's like you actually you shifted the odds in your favor, and like you rolled a dice that like was supposed to roll good for you. It just didn't roll good for you that time. So that's why for a lot of people, DCA is the better concept. The first level to be able to be comfortable, to understand that they can lose and still be okay. Like when Trump's tariffs came out initially, right? It tanked a little bit and you might feel some sort of regret, but ultimately like you only know that after the fact. And we've done extremely well for what we expected to come out of Trump's presidency. We've done really well.
Yeah, 100%. How often do you check your portfolio car? Do you check it often, and do you do it as because you want to make any changes to it, but more so from a lens of curiosity?
For sure, curiosity. When we've last talked, it was almost daily, and like for sure, I didn't care, right? Because ultimately, I'm doing this. I'm not changing my strategy. It doesn't matter how often I look at it. Now, less so, mainly because I guess it's because our funds have been so strapped. I would say like we're paying for a lot of different things. It's been hard to find in our budget until my wife goes back to work. Like we're doing okay financially, but it's not like we have a lot of money to invest every week. So until then, I think like I haven't been looking at it as often as before. But what brings me joy is logging into Questrade, looking at my daughter's RESP. That brings me the biggest joy. It's like at 15K, it's the market has or grants have given it like 4 to 5K, and it's like to me that's bonkers. And we had someone on Blossom, you know, you've seen it, what's his name, who was trying to make their RSP 100K or something by a certain age. And I think, hey, I'm gonna probably get somewhere close with just XEQT and the grants. And I don't know, like once I always like fantasize about my daughter's reaction once we tell her like this is what
that's
this
amazing.
is your RESP. It's like what the
it's so fantastic that Carl, we do have these type of products here in Canada. I mean, you're very fortunate in that regards, and I think it's just, and I mean, the more we talk about some of these products, of course, the products are out there, it's known, but I feel like, you know, sometimes some parents may not know. Like honestly, you don't have to start necessarily with a large sum of money. Even get started. I think that's really it really helps down the road. You're investing in your children's future. And I know in the beginning we had some questions. Joe was asking like, well, I don't know RESP. What if my child does not go to? And I mean, he was very hesitant, but I feel like ultimately he might have already been convinced and opened up an RESP. But I mean, I think that's the beauty of a platform such as Blossom, because we get to talk about these topics, provide our perspectives, and at the end of the day, I don't think necessarily anybody, for the most part, I don't think anybody's trying to. I mean, maybe we are trying to convince each other, but I don't think that's the goal. The goal is like hopefully having a healthy debate and conversation, and you get to take away whatever resonates with you. Maybe piques your curiosity, like, hey, that's something I want to look into further. Doesn't mean that you have to change your approach, but at least you keep an open mind and trying to learn about that. Maybe not today, maybe in future that might be something that interests you. That's what I love about Blossom. What is the best thing about Blossom that you love about it, and perhaps what is the one thing that you don't like as much, and if you could improve, you would improve upon?
That's a good question. I think building friendships such as this one has been the biggest boon. It's obviously a social media app that is in its beginning stages. It doesn't have these moderations or these filters that, or more complex algorithms that these other platforms like Twitter or X have at this point. Like, one of the complaints now is that people are seeing, too much of the same type of content, but I think as long as there has to be a way for people to be able to filter that. I think that's maybe the most negative I can think of at this point. But I do think people should be able to, if they're posting it on their wall or whatever, like me, I post all because I don't want to preach. So you'll notice a lot of my stuff does really well and eventually makes it to people's feeds. But I intended to not post in any community because I don't want to trigger anyone. I want most of my followers to read it, but like all these people that crap on covered calls are posting in all these communities, and like people are now tired of that because they're seeing it a lot in these at the end. But at the same time, I think they should be able to post it if it's like sort of on their wall and people want to see that type of content, because right now it's triggering people, covered call people that have done more research or believe they know what they're doing. So the constant warnings is annoying, but also the content's not for them. It's for like beginners. It's just like how we tell people to be aware of mutual funds because of the fee. Why is that not annoying to people? Because a lot more people are more attached and passionate about covered calls. But we do post regularly about different beginner warnings all the time. But it is fair that it might be too much for certain a certain audience who would like their feed to be more advanced, right? Don't give me all this myths, beginner stuff that I already know about. Max has said he's working on that stuff, and instead of being just a complainer, I've always been a positive supporter, because I hope Max seems like a cool guy, and I hope this platform works for him.
That's amazing. Yeah, 100% agree with you, Car. Blossom has evolved so much since its infancy, and we have now, I think I heard over 400,000 users. That's just amazing. Are you going to be in one of those Blossom tours this summer? I believe in Montreal, possibly. Not sure.
Maybe like if you were going, but
yeah, I mean Montreal, unfortunately, is too far away from me.
Yeah.
I'm going to be with the one in Calgary though this year.
Because last time I met two people that said they were going. I had a great time with them.
Yeah,
but,
oh nice.
Probably would have been highly interested in the Toronto one because Ben's going.
Yeah.
But for this one, we'll see. Like I'm undecided because most of the panel is not for the index investors. Just a lot of content about different active approaches possibly. And so it would really be about meeting people for me.
Yeah. That would be cool. Have you attended one of those? You said last time you did attend. That was in Montreal, right, Car?
That you had on the show.
Great guy. Oh, cool. Oh, that's amazing. Yeah, because he lives in Ottawa, right? I believe so.
He actually rode on a motorcycle.
No way.
Rode all the way to the event. So that's kind of nuts. And I met someone named Kevin there. Talked to both of them. I met a few people that said hi, that they watched my stuff. That was nice.
Awesome.
But ultimately, like the event, you just because like. The value would be, if I was an active investor, would be to find like-minded guys to discuss better active strategies. but I'm not an active investor.
I know. To me as well, Car, it probably would be a lot. Attending probably would be a lot about those meetings and getting to know people and whatnot. I mean, in one of my comments, I didn't call you as well Ben Felix Jr. Like, I absolutely enjoy your contents. Like, I think you have a great talent in terms of how you put your thoughts into words. You make it data driven yet not complex. You have a great talent in simplifying it for the average user. So I appreciate that. I just wanted to give you that shout out as well, man.
Yeah, for sure. Like both of us definitely put out content in the hopes that at least one person can relate to it. That's why we do it. And when we see that real life, it manifests in real life when someone tells us that, obviously it feels really good because it's the goal. And yeah, that was my approach when I called it. I'm going to change the title just to have my name, my YouTube once I come back. But that was the goal of being simplified because I'd have to watch, even me, a Ben video possibly 5 times sometimes because he's referring to concepts that would be in a finance glossary sometimes. Like you don't really know, like factor premiums once you start out as a beginner. Like what does that even mean? What's a factor premium? And so I was always trying to bridge the gap between the two and appreciate you letting me know I've done a good job because that's always been my approach as the non-finance guy, but that also is very data driven in his approach to try to bridge that gap. So appreciate that.
Of course, 100%. I do appreciate that. I know we talked about a variety of topics, so I appreciate your inputs as always, Car. Thanks for coming back on the show. Before we wrap up, any final thought, anything else that maybe any question that you wanted me to ask and I didn't get to ask you, anything else that you want to touch on before we wrap up?
No, just I think back to reinforcing the fact that some people use quotes, just a warning, like the investing quotes that really apply that were built off the buy and hold diversified strategy. Like timing the market is better than timing the market. That really applies to that. Lump sum is the same thing. So a lot of these research is where they're comparing diversified versus not diversified. And again, defending our approach even through the retirement stages. We're not, again, to your point when you talked about selling at set intervals or whatever, like approach, like some people might, like the counter argument, it would be like, okay, but you're human, you might screw it up. But again, it's not that different. Like I'll trumpet this. It's not that different from any other style where you actually have to actively do something anyways. So when you mention it as a con, it's an unfair, biased con without comparing it to what you're doing on the other side is all I want to make sure people can recognize that. Ultimately, you can still take cover calls because you like it, but the advantage of cover calls versus our index strategy is not as vast as people are making it out to be, right? We're not draining our shares to zero.
To your point, it can boil down as well to some of those personal preferences, right? So
right,
somebody
like,
may value this.
I'm not saying don't do it. Like I'm not those people because it's not productive discussion. Do it because I trust, like Paul Perry, I trust your knowledge and that you know the risks are involved in your strategy. I'm just saying this other side is pretty good too for a beginner wanting to choose between both. And selling shares and needing to market time, those aren't really valid counter arguments once you break down the math.
As always, appreciate your wisdom, Car. Thanks for your time coming back on the show. We should make this probably a more regular thing. I know. Let's see how the community responds, but I always enjoy talking to you. It's super smart. Definitely look forward to the day that I can meet you in person. I think that would be fun.
Yeah, I look forward to that too.
Awesome. Thank you so much, my friend.